contracts over the weekend. So people are getting them. So stay inspired. Sometimes the hot properties, and I'm bringing Kenneth in now because I know he was looking too. But sometimes the hot properties are a little harder to find. So I always try to tell my clients to, stay aggressive, try to be the first person to put your bid. And when things go contingent, have your agent constantly follow up because sometimes deals do go bad. And I'll go ahead and get the intro out. Thank you guys for joining us. I am Loans by Natasha Robinson, MLS number 332074. Thank you for joining Mortgage Move Mondays, where today we are going to talk about understanding your mortgage payment. We come together every Monday at 6 p.m. There are no house rules. You can come on camera and ask questions. You can ask questions in the chat. My team member is in the background. We are live on multiple streams. So if we don't see all of your questions, we can definitely get them to you. My team was just talking here about not being able to find properties in this market. And that's not today's topic, but I know I see some other names on the Zoom today. So I know that is a challenge. But my advice to you is to stay encouraged. We do have different buyers. Like, my one client, she's looking at South Shore. South Shore is a hot area. North Kenwood, hot area. Bronzeville is hot area. So the hotter areas have limited properties available. So you definitely have to move quickly. And sometimes you got to give them their price if you can afford it, because you cannot buy it for more than what it'll appraise for. So if you were to bid the property for a certain amount of money and then the property didn't appraise, understand that the bank will only land on the value. Now, I am a lender that gets value in the community. So if the value is there, you would definitely get it. So you definitely want to make sure that you are okay paying the price if you get the value. But I think that also helps. Another thing is have strong earnest money and quicker closing dates. Like if you want to do a renovation loan, like if you're pre-approved for any loan, you can do a renovation loan with me. If you're getting a renovation loan, a lot of listing agents don't like those because they can get a cash offer. Well, if you guys have a quick closing and higher earnest money, that will help you win your bid, because that tells them that you're a strong buyer and a quicker closing date. So if you think in renovation, you want to have those contractors, you want to understand how much things cost, which is another Zoom, but I did see some names on here that are frequently listening. So definitely try higher earnest money, try quicker closing dates, and, try to write a letter to the seller. Sometimes that works, like, hey, been looking for a long time. I know you got a lot of options. Me and my children or family, we're going to raise our kids here. I'm not a big fan of that for the offers that I present, but I do see a lot of agents that do a lot of creative things. So we're going to make this a topic. And then I'm going to bring some experts on. So I would say in the next couple of weeks, I'll topic that. So that way hopefully you'll have a contract by then, but I'll bring that back as a topic. So what makes up your mortgage payment, right? So a lot of times when you're talking to your lender, and I know I am a lender that talks fast, sometimes you need to slow down with what makes up the actual mortgage payment. And the mortgage payment consists of principal. That is the amount you're borrowing. If you are buying a home for $100,000 and you're putting 5% down, that is $5,000. So you owe $95,000, which is $100,000 minus $5,000, right? The interest is the cost of borrowing the money. So when you make a payment every month, if your principal is $50 and your mortgage payment is $1,050, then you would have paid $50 towards that $95,000 we just talked about. And then the rest of that $1,000 would be your interest, right? So I only say that to tell you that the majority of your mortgage payment, especially in the first 10 years, is interest. Why? Because it's over 30 years. So if you were to purchase a car, and normally a car is 5 years, but I know now they're doing the 7 and the 8s. Your car note on a $90,000 car is like a mortgage, $1,600, right? $1,700, $1,800. If you bought a house for $90,000, your principal and interest payment may only be $600 because it's over 360 months versus 60 or 72. So your mortgage payment on a mortgage is going to be lower than installment loan on a car or anything else you buy. And the reason for that is because the term is longer. But what happens when you're in the longer term is you're paying more interest. I wish I had this in a slide because it would blow your mind. But if you have a loan with me, and you're under contract and you got a loan estimate, if you look at the last page, it'll show how much you end up paying for that home after 30 years. And I think the last one, I think the purchase price was like 400,000, and their interest was like 100 and something percent. It was like a crazy number. And the reason is because it's over 30 years. It is not over a shorter term. So that is why your principal, the amount you pay for principal is so small, because you're just giving small increments 360 times until you pay that house off. Interest is the cost of borrowing the money. So like I said, the interest in the first 10 years is generally much higher than the principal. That's how the banks make their money. They live off interest. If they're making $1,500 a month and they have 10 mortgages, right? That's $15,000 a month that they're making just off of you paying your mortgage payment every month. So the interest in a mortgage is a really big business. And a lot of banks make a lot of money. I'm a loan originator. We don't make money off your interest. The servicing companies make money off the interest. We are the ones that take the risk to originate your loan. If I originate your loan and I say this person is a strong buyer and for some reason you were to foreclose, now I would be put in a position with the bank, if it happens in a short period of time, to give them the money back for your house, because it looks like I didn't underwrite the wrong loan property. So you have your originator and your servicer. Some banks do both, but just to kind of break that down for you, I am an originator, and then you will end up with a servicer, right? Mortgage insurance is your homeowner's insurance. It's required by lenders. Why? Because if the house catches on fire, we want the mortgage to be paid off. Monthly mortgage insurance is something else you pay for. When you don't put 20% down on your property, you have what's called monthly mortgage insurance, okay? That is a small portion. That is insurance to the mortgage company. What happens with banks when you don't put 20% down, it generally costs you 20% to sell your house. So if you were to foreclose, the bank has another company. So that same house for $100,000, if you were to foreclose on that house, the bank would be secured because the monthly mortgage insurance would cover 20%, which is generally what it would cost them to have somebody to relist the property, put it back on the market, the time it may cost to sell, credits. So they're actually getting $15,000 of that money from the bank, and then they are only at risk of the $80,000 that's left over because they forced you to pay what's called monthly mortgage insurance on that mortgage. So it just shares the risk between the banks and the mortgage insurance companies, because generally at 80%, a bank normally can get out of a loan. Sometimes they can't, but generally a higher percentage of the time they can. Upfront mortgage insurance is common on FHA and VA loans, and it's the cost to do business with the government. So FHA charges 1.75%. If you are in an FHA loan, regardless of how much money that you are putting down, you will pay 1.75%. If you are a veteran, that fee can be 0 because you're a disabled veteran. It could be 2.1%. It could be 3.4%. Just depending on how many times you used your VA and how much that upfront mortgage insurance premium. The upfront mortgage insurance does not go to the bank. It goes to FHA or VA or whatever loan you're in. And no, you do not pay it up front. You pay it over 30 years. So if your loan amount was $95,000, like we spoke about, and your mortgage insurance is $1,500, we will be financing $96,500 because we're adding the mortgage insurance to your property. So you don't pay it on the day of closing, but you will pay it after the 30 years or whenever you sell that property. Any questions on the mortgage payment, the principal, interest, taxes, insurance, monthly mortgage insurance, and upfront mortgage insurance? Okay. Okay. Yes, so you can buy as many homes as you want. We actually have a down payment assistance program for the second home. So the IDA grant will allow you to get a second mortgage and a second property and also give you a grant up to $10,000 for that property. Now, of course, when you buy your second property, we are looking for you to live in that property if it's going to be owner occupied. But if it's going to be an investment property, that's okay too. You just will have a higher down payment. So you can purchase as many properties as you want with me, 1, 2, 3, or 4 units. Owner occupied, I can do regular loans, down payment assistance, and renovation loans, 1, 2, 3, and 4 unit. Investors, I can do 1 to 4 unit regular, no renovation. And if it's a renovation loan, I can do 1 unit. If it's an investment property, you're probably looking 15 to 25% down once you get into the investor stage. Awesome sauce. I don't see her mic off, so I don't think there's any more questions. So why does it matter? You said what? Awesome. So why does this matter for you, right? Understanding your mortgage payment empowers you to budgeting. The mortgage payment is something you're going to have for 30 years. So I always tell my clients, your first home does not have to be the home, right? Like I have purchased several homes and I still don't live in my dream home, right? So with that being said, the first property that you purchase does not have to be your dream home. You can grow with your property, but the most important thing for you to do is get a mortgage payment that you can afford. I see a lot of clients that will push the bar and it becomes overwhelming because you don't want to be house poor. And I know things are so much more expensive, but you do have some options like going to Indiana, which, you know, people don't like when I say that, but they do have more affordable properties there. I am licensed in Indiana. You know, sometimes if you go a little further east, just looking at different deals, maybe you wanted a house, so now you're going to get a multi-unit because you want to utilize the rent from the other units to basically get where you're trying to go. But it's all types of options. But remember, when we are looking up your mortgage payment, remember, we do not see anything else. I can't see if you play poker every week. I can't see if you go to the casino. I can't see if you have a business venture that is costing you additional funds every week. If you have a kid in Catholic school or at Howard like me, who just tanked me with the largest tuition bill I ever seen in my life last month, right? So with that being said, nobody knows your problems or your life or your bills, and they may not even be problems, but we can see only what we can see. So if you cannot afford your mortgage payment, definitely make sure you don't commit to a 30-year mortgage, because you want to just make sure that your house doesn't become a hindrance to you and it actually becomes an asset, something that you can hold on to. Mortgage insurance, we talked about that a little bit. I want to explain mortgage insurance because a lot of people really don't know what mortgage insurance is, right? On an FHA loan, you will always have mortgage insurance when you start. If you put 20% down on an FHA loan, you will have mortgage insurance. However, if you do a 15-year term or you at least put 10% down on an FHA loan, the mortgage insurance will go away after 10 years. On a conventional loan, and there is a difference between an FHA, government, 3.5% down, 1, 2, 3, and 4 unit, conventional, 3% down on a 1 unit, 5% on a 2, 3, and 4 unit. So there is a difference between the programs. But if you put 20% down on a conventional loan, you will not have the monthly mortgage insurance. Monthly mortgage insurance can range you from $46 to $600 a month, depending on how much you owe, what's your credit score, and what your debt to income ratio is, right? The mortgage insurance protects the lender. Like I said, if you had a 20% equity position in your home and you didn't pay your mortgage, you probably would not pay your mortgage because you know you could sell that property, at least break even or make some type of money, right? The higher the purchase price, the more flexibility you have. But if you don't have 20% equity and you get above water, sometimes it's better to sit it out, pay late to the mortgage company, live there as long as you can while you don't make mortgage payments, so that having that mortgage insurance and that other lender that's going to say, bank, I'm going to give you the 15% or the difference between what the buyer put down and the 20%. I'm going to give that to you on an insurance check. So now that way you can utilize that to help evict that person that's not paying that rent and get the property back on the market and sold to another buyer, right? It's based on your loan amount and it's based on your credit score. Credit score is a big deal. And now, since they call them LPMIs, right? Now it's based on your debt to income ratio. If you make $1,000 a month and your mortgage and all your bills are $450, your mortgage insurance will be at its lowest. If your bills was $470, you would be at 47%, and your mortgage insurance would probably double just because your debt to income ratio is over 45%. So they're going to look at your credit score, they're going to look at your debt to income ratio, and all of those things to help you get to that finish line, right? Upfront mortgage insurance, we just talked about that. That is on FHA mortgages. There are ways that you can do lender paid MI or other options, but in today's market, the monthly mortgage insurance is cheaper than trying to pay it up front and things like that from what we've seen. But we always run case-by-case scenarios. Back in the day, the mortgage insurance used to be better to do the mortgage insurance, the paid MI, where we paid maybe $1,500 up front and we didn't have it anymore. But those options haven't been as nice as they were back in the day. So as things change and shift, we always offer to you what is best available at that time. Property taxes, guys. Property taxes is something that you're going to always pay. But I have a lot of people on the call today that have actually been pre-approved. So in Cook County and many other counties, but in Cook County, our taxes are paid in the arrears. What does that mean? The tax bill that I'm getting in 2025 is really for 2024's taxes. Well, guess what? If you close on a property in April, you did not live there any of 2024, and you did not live there in January, February, March, or April of 2025. So because of that situation, when you buy a property in many counties, you get what's called a tax credit. And when you sell a property, right, you have to give a tax credit. So property taxes are something that's added to your bill. If you do not put 20% down, we have to include taxes and insurance. I get called all the time. Why do I got to include my taxes, insurance, and my mortgage? Because if you don't pay your taxes, you can lose your house. So that is a risk to the bank. So the bank is going to make you include your taxes and insurance in the mortgage unless you put that 20% down on that property. And then at that point, you end up having that option to not put the taxes and insurance. If you're a first-time home buyer, I recommend all my clients to put it in there, because that's something you just don't want to worry about. I got a lot right now that is free and clear, and I have to go and check all the time. I have anxiety because I don't want my taxes to get sold, and I wasn't aware that my taxes got sold. So you definitely want to pay attention to your taxes. If you guys have separate tax bills out there, make sure you're getting your mail at your home, so that way you don't lose your property. I have a girlfriend who just got so busy and she lost the whole house because she forgot to pay the taxes and she wasn't getting that mail, and she lost the house, just like that. So she was very upset, but it happened. She got over it. But the fact is that you lose your house if you don't pay your property taxes, which is crazy insanity, right? Your taxes are based on the assessed value of your home. For all my people who love the South suburbs property taxes are a bit higher. I had a client today. She wanted to buy in Dalton. The house was $180,000 and taxes was $9,500. So that made her not be able to afford that mortgage. But with that being said, she wasn't able to get that particular property, but she decided she wanted to look for something with lower taxes. So check the property taxes. Taxes get a home owner's exemption. And if you're 65 or older, you get a senior's exemption. If you are a veteran and you are a disabled veteran, I think you have to be an 80% disabled veteran. You do not have to pay taxes in Cook County. I love that. And I try to inspire my veterans to purchase in the South suburbs where the taxes are higher, because you don't have to pay them. Now, I don't know all the rules. Mr. Cook said, I wish my taxes was $9,000. I know that's right. But I don't know all of the rules to, how much, if it's actually zero. I know one of my clients did come back and let me know that her bill was not zero, that it was based upon the value of her home. And once it went over a certain value, she had to pay the difference. But property taxes can definitely, eat you alive, and they are going to continue to go up. Property taxes are something that will always go up. And then when you become a senior, hopefully will, eventually come down. And when you're old enough, you get what's called a senior freeze, and the taxes end up frozen, where you don't have any taxes, but that takes quite a little bit of time. And that is, definitely what is included in that mortgage statement there for you. So just understand your property taxes. When you guys look at properties on my pre-approval, at the bottom, it says taxes and insurance. And if you're looking at a multi-unit, it says rents of the estimated rents. So if you were purchasing a 3-unit property and we averaged your rents at $1,500 a unit, and then you go look at a building and they're all 1 bedrooms and they're getting $800, you got to call me back. I need to give you an updated pre-approval. If I put the taxes at $5,000 and you find a property and your taxes are $12,000, you got to call me back. I need to make sure that you qualify for that house because something has changed on that pre-approval, which basically was the amount of the taxes. Thank you so much. The veteran disability is 70% for zero in taxes. So Mr. Cook, if someone has, just say for instance, okay, so he says 0 in taxes. So my girlfriend moved to Orland Park and her husband is disabled and her house was $675 and he was 90% disabled, I think. And they're making her pay a portion. So I don't know the rules on that. I'm going to get that and we can send it out to everybody. But I love to know that it's 70% because I said 80 to be safe. And we got a veteran on the line and he knows his stuff. So I love it. And thank you for your services, Mr. Cook. But 70%. So if you are a disabled veteran and you are 70% disabled, you purchase a property in Cook County, it looks like you have to pay $0 towards taxes, which is absolutely amazing. I have a client right now. He's looking at a house in Olympia Field and the taxes is $23,000. And I'm so excited for him because if he gets that house, I can't imagine the relief of not paying $23,000 in taxes. Like that will have to be so worth all of the services and things like that. And I know that's just a small token of appreciation for all of you guys, all the things that were done in service from our veterans. So I know that even getting a tax-free doesn't amount to all the services that was done for us. So thank you, thank you, thank you, thank you. But I'm glad that they actually are doing something for you guys because that is absolutely amazing. Okay. Yeah, so for veterans, are you talking about, well, I'll talk in general. So veterans put 0% down. They still qualify for down payment assistance programs, but sometimes their interest rate is so low that it doesn't make sense to do a down payment assistance. Now, I have a program that I've been using like crazy. It's called the CHAC grant. And that particular grant will give you $10,000 and they really don't care. They don't care about your credit score and they don't give you a higher interest rate. So that one is in particular is amazing. You could do that as a veteran and you could do it as a regular FHA or conventional loan. And then we have the IDA grant and we have the Chenoa grant and the Equity Aid grant. And we have a lot of different options just depending on how much money you make, what's your credit score, and what's your debt to income ratio. And everybody's going to know before we leave here today that debt to income ratio is your income versus your debt. So if you make $1,000 a month and with your new mortgage and all of your car notes and everything, your bills equal $450, then your debt to income ratio is 45%. So a lot of the down payment assistance wants you to be at 45%, where on an FHA and VA loan, we can actually go to 56%. So Mr. Cook is coming back in to say a qualifying veteran with a service-connected disability of at least 30%, but less than 50% will receive a $2,500 reduction. If the veteran has a service-connected disability of 50%, but less than 70%, then it's $5,000. Oh, this is great. And if the veteran had a service connection disability of 70% or more, the residential property is exempt. Let's go, knowledge and transfer and guidelines. See, look, I got my clients teaching me today. I know that's right. I love to see you when you online, Mr. Cook. I love my clients that know their stuff. Let's see. I see another question. Oh, one team, one dream. Let's go. Let's go. Mr. Cook is a client. He's been a client of mine for a little while. So basic loan program overview, right? So we have the conventional loan, which we talked about today, 3% down for 1 unit, 2, 3, 4 unit is 5% down. And I say this all the time, guys, I can go to $1.4 million, 5% down on a multi-unit. We do not have to live where we thought we had to live. We don't have to go to Inglewood. We don't have to go to the areas that fit within the loan limits anymore because now conventional jumped out. They said with 5% down, we can live wherever pretty much we can find a building with a loan amount of 1.5 million, which isn't in a lot of places, if you ask me. So I think that's absolutely amazing. Conventional has higher loan limits. FHA for that 4-unit, you'll be at about 1.1 million. VA is 0% down. Veterans don't pay any mortgage insurance. The VA funding fee depends on the veteran. I know me and Mr. Cook is talking about disabled veteran. Once you have with your disabled veteran, your VA fee is waived, which is awesome and amazing. And then USDA loans, we can do 0% down, and you can get 0% down when we combine down payment assistance programs as you qualify them. All down payment assistance programs is not free. So some of these programs, I had a client yesterday, the IDA was at 6%, and the IDA was at 6.5%, but the regular FHA was at 5.99%. So we took the 5.99 because it was just cheaper money for the client, right? So keep in mind that just because it looks like it's free doesn't mean it's always free. So you always want to go over your mortgage payments to make sure that you're doing the best that you can for you. So I got some questions coming in. Can the depreciation be written off for 7 years on your primary home, or does it have to be an investment property? Depreciation is definitely written off. I'm not for sure exactly how long you can rent it off. You can talk to an accountant, but I'm almost certain that you can write off depreciation for so many years. And then after that, once you fully depreciate the property, then you can't depreciate it anymore. So if the value of your home was 500,000 and you depreciate it over time, once you get to the complete depreciation of the property, then that's it. You can't depreciate it anymore. But we will get an accountant on to answer those questions for you. Does the veteran assistance apply to widows of veterans? So, Ms. Smith, I don't like to speak when I am not the expert on this, but I'm almost certain that if you are a widow, you have to contact the VA. You have to ask the VA to transfer the veteran certificate of eligibility to you. If it is transferred to you as a lender, it is not my business to find out how you got the certificate of eligibility. I would just be moving forward with that. So whatever, if the VA gives you the ability to purchase with the veteran's certificate, then you definitely can use it, but you definitely will have to get that, go through the proper paperwork with the veteran. Are there assistance programs to assist renters that need assistance to prevent eviction? Yes, Mr. Cook, as a matter of fact, you got to I got your number. I'm going to call you. One of my clients is selling his building and he was able to get $15,000 per unit. I don't know how he did it, but I know he did it. So I'll get you over to the person that assisted him with that. So that way you can see if that works for you. Sorry that you're dealing with that. 5-day late, 5-day notice, everyone. I know we're new landlords and sometimes we're our owners and we get to see our tenants. But if you follow the 5-day late, 5-day notice, sometimes when let me give you an example. If T-Mobile did not charge me reconnection fees, I would get my phone disconnected all the time like I used to because I just pay the bill. I know they're going to turn it back on, right? But now that they charge me $25 per line and I have 11 lines, I don't get it disconnected because I can't afford to pay $250 just in reconnect fees just because I paid my bill 5 minutes after it got disconnected because we need our phones, right? So if you give your tenants 5-day notice when they're late and you let them know that if I go forward with the eviction, I'm going to charge you the court costs and all of that stuff, sometimes that scare will keep them in line with paying you on time because they know you are not the person to pay late. And I am so excited about all you guys' questions because I am just rolling through here. We have another question. Can you apply or qualify for multiple down payment programs? Tiffany, the answer to your question is yes, you may. You can combine the CHAC $10,000 grant that I spoke about today pretty much with any other grant. And there's also other grants out there. For my University of Chicago people, I did a deal for a professor. He worked at the university. They gave him $50,000. I was able to utilize that in conjunction with other grants. So yes, case by case scenario, but it's definitely something we can do. And then I have Mr. Cook coming in. An unremarried surviving spouse of a veteran who is disabled and is now deceased can continue to receive this exemption on his or her spouse's primary residence or transfer this exemption to another primary residence after original primary residence of a veteran with a disability is sold, provided this exemption had been previously granted to the veteran with the disability. The surviving spouse must occupy and hold legal or beneficial title to the primary residence during the assessment year and submit the form. So I think, Mr. Cook, that question was going to, can the spouse keep the tax exemption to not pay the taxes? I think the other question they were asking was, can the surviving spouse take advantage of the veterans benefits? So the good thing is you have all the answers. So it looks like you can transfer the cert, and you also would have to contact the VA if you wanted to take over the certificate of eligibility as if you were a veteran, if your spouse were to have passed away. This is great, guys. Look, y'all gotta tune in to Mondays. Y'all showing out. I love questions. Y'all see how I get excited when y'all ask me questions? Well, let's see. Looking for my cursor here. So that's pretty much my slide stack. I'm gonna go to my system. So I am doing, it is Financial Literacy Month. I don't know if you guys know, but I did start a foundation in 2013 that I never had time to run. And this past year, we did our first event. It was called Black Friday Reversed, and it was a wealth symposium. We had, I'm talking about MC Light, we had Bobby Simmons, Jamal King, we had some Marky Lemons. I don't want to miss anybody's name, but if you guys would have seen our lineup, it was spectacular. It was on Black Friday. On Black Friday, there are millions of dollars spent on consumerism. We made that a day of wealth building. We gave away TVs, everything, to people to come out and learn. We gave away toys. It was absolutely amazing. We had 1,523 people registered, 723 people walk in the door for an event that was planned in 39 days. Now we are leading up to Black Friday, which is in November. And for the month of March, we are having a weekly series. These are in person. So we had one last week. It was absolutely amazing. So we can get you the information. It was how to fund your own business with business grants. We had Huntington Bank there, and we had someone that can teach you how to get the free city money. If you have a commercial space, they do have a grant open with the city where they can get you $250,000 for a commercial business. So we can get you the consultant's information if you want information on that. This week, we're talking about retiring with real estate. It's going to be at my office in person, 54 East 26th Street. So if you guys have not had a chance to physically meet me, come out. I do have a full bar at my office, so you guys can enjoy some cocktails and have some snacks there while we listen to Retire with Wealth residential seminar. I see a comment right after that. Then we have Mastering the Stock Market. The week after that, my good friend Ebony Lucas, she owns an infused ice cream shop. You can get ice cream with liquor or without liquor. It's called Nitro Nostalgia. We will be back there mastering the stock market. We have some special guests. I don't teach anything that I'm not licensed to teach. So at all of these events, you will have licensed people teaching the topics. The following week is going to be commercial real estate, and that is going to be back at my office at 54 East 26th Street. And then we're going to end the month with something that is deep in my heart because I have more work to do on it, but it's going to be called Wealth Builders Meetup, Estate Planning and Probate. We're going to be talking about wills, trust, estate planning, and what you need to do to handle your business so that way you don't pass away and other people have to handle it for you while mourning. So you can definitely scan that QR code and you can sign up for one or all of the events. That last event is going to be in Lansing, Illinois. So if these events that were in the city were just too not in your area, we are going to be in the south suburbs in Lansing, Illinois for that last one at the Royal Bistro Live. So definitely keep that in mind. It's going to be 6 p.m. to 8 on every Wednesday until the last Wednesday of the month. And after that, it'll only be once a month. So we are only doing it every week because of Financial Literacy Month. But starting May, it'll just be one event every month. And we're going to lead you to get ready. So when you come to the expo, you'll have a different mindset and you'll have different questions. And you will be a little more advanced. So you'll understand some of the things that the speakers were talking about. It'll resonate with you and you can keep building your plan from there. So we're always going to keep working. And as always, you guys can follow me on Loans by Natasha on Instagram, Natasha Robinson on Facebook. And my website is loansbynatasha.com. So you can't forget it. You guys can scan and get that information as well. And then I'm going to come back on the camera here because I was doing my little non-slide earlier. But let me know if you guys have any more questions. I'm checking the blocks now. Tiffany said, thank you, no worries. And look at Mr. Cook was in the building. Let's go. Yeah, so if you guys have any questions, let me know. But I try to keep this Zoom quick for you guys so that way you can tune in weekly and get more information. If you have topics that we missed today or tonight, please feel free to drop the topics in the chat so that way we could bring back what you want to hear about. But I am going live in 2025. I was told that I have all this information, so I want to make sure I get it out to you guys so that way you don't feel like you're just emailing me back and forth. We want you to be working with a live person. So if there is no more questions, that is all I have for you guys today. Ms. Smith, good luck on your search. We're not gonna give up. We're gonna bang it out, and I'm gonna be keeping. I'm gonna actually do a post that I'm looking for a property in South Shore today and see if I get any bites for you.
Okay, thank you so much.
Anybody else looking in a certain area I need to help get a bite for you guys, let me know. I'll put it out there and see if we can find you some off markets.
Quick question, Natasha. On a Wednesday about the retirees, is that for future retirees or if you're currently retired?
That's for people that want to retire with real estate. Okay. So if you want, like, I want to retire. I've been trying to retire since I was 30, and I'm not gonna tell you how old I am. But with that being said, so it's teaching you how to retire with real estate. Ebony is gonna be there. I think she has about 86 doors. So she is actually ready to retire, but she is probably gonna keep buying doors. But with that being said, just getting you built up to what is it that you need, what are your goals, how do you get there? You know, you're from Making Real Estate Real, so Jamal King teaches us to buy one property for every bill, you know, that we want to So if you want a G-Wagon, he wants you to purchase a property so the rental income on that property will pay for the G-Wagon. So that's retirement for him. So retirement is different for everyone, but we're just going to be talking about how to utilize real estate for retirement.
Okay.
Okay. Awesome. Right. And we'll get some clips from that one. That one won't be on Zoom, but I will continue to have my my Zooms every Monday. And on Tuesday, it's a little more high level conversation on Tuesdays. So that way we get something out to the realtors or to those that may not be first time home buyers, but you guys can always tune into anything and you can always ask any questions as well. There's no such thing as a bad question.
Thank you.
Thank you. You guys, wait. I see a red box. Okay, I already seen that. Thank you, Mr. Cook. Well, you guys have So that's a good question. So that is a great question. So equity is a little different. So like some people will let you utilize your equity. They want you to at least have 5% equity. So if you have 10% equity, they'll let you borrow 5%. Generally, you want to be at about 20%. So that way, if you can get about 15% of equity, and what we mean by equity is that we're going to use this $100,000 number that's low. But if you have a house for 100,000 and you have 80% and you're at 80%, that means you have $20,000 in equity. So the line of credit may say, okay, I'm gonna let you go to 95%. So I'll give you a second mortgage for $15,000. So generally, if it's your owner occupied property, you want to have at least about 80% loan to value to utilize your equity. Now think about a bigger purchase. Think about if you had a house for 500,000. You know, if you have 5% equity, that's $25,000. So somebody may want to use 25,000 of their equity. So everybody is different because your purchase price is going to determine your loan to value is going to determine how much you can utilize to get equity from your home. And generally you want to wait until 1 year. Normally most appraisers, 99% of lenders, they're going to go off your purchase price as your appraised value for the first year. And after that, then they'll reappraise it so you can get new value. And then nice, Tiffany. So Tiffany's been working on her credit. Let me go. Let me find these getting back in my messages here. So Tiffany's been working on her credit. So I'm the type of lender where if you come to me and you are not ready, we do not just cut you off. We try to put you on a plan or link you to someone. Can you apply or qualify for multiple down payment assistance programs? That's an old question. Let me go. Let me scroll down, guys. I'm sorry. Do you have a list of reps in Texas? I do. I have a big team in Texas. Horace, are you in Dallas, Houston? Where are you at? I'm licensed in Texas, guys, too, so tell everybody. And then Thanks for having Terry Castle. My credit score is now 620 due to her knowledge sharing. I so appreciate it. Yes. So Tiffany, when you're ready, I don't know what our target score was, but when you're ready to come back, we'll definitely get you rocking and rolling. Mr. Mack, I can get you to Dennis Brim. He's in right there close to Dallas. So if not, I know he moved his practice from Chicago there. So he has a lot of agents. So I have your information. I was going to check in with you too. So I will get you over his information as well. So that way he can get you into some Texas deals. I actually want to live in Texas one day. So we'll see. We'll see what the world has for me. Yes. So this was great, guys. I was pushing myself for this one tonight. So I'm so glad that you guys engaged with me. You had questions. I feel so honored and excited to be able to share my expertise and actually learn with my clients. Any more questions?
We appreciate you. Thank you very much.
No worries. I'll see you guys next time. Thanks for tuning in. Have a good night.
Good night.